Investing in dividend-paying stocks is one of the most popular investing strategies out there. There are literally hundreds of thousands of videos on the YouTube platform alone highlighting the benefits of receiving a regular, passive income stream. And some of the most popular index funds in the world run income-oriented, high-yield ETFs that have billions of dollars in assets under management and exclusively focus on holding shares in dividend-paying companies. But what if I were to tell you that the ideal company to invest in, the perfect stock, does actually not pay a dividend? That's what renowned investors like Warren Buffett and Harry Smith think and have publicly articulated, and in this video I will reveal the truth about dividend-paying stocks and outline the top 3 reasons why you might want to avoid them. So without further ado, let's get started. Alright, I recently read a thread on Twitter in which one of the Twitter users claimed that, quote unquote, whether a business pays a dividend or not is irrelevant. And I have to say that this couldn't be further from the truth. I mean, I get it. I get why people are attracted to your, hypothetical, steady and regular income stream. Of course, this idea can be quite seductive, but it's your psychology that is trying to trick you here. Instead of focusing on receiving a regular income stream and considering how high of a dividend an individual stock is paying, you should focus on total return instead. So that's the growth of a stock's share price over the long term, which reflects increases in earnings power, changes in the valuation multiple of that stock, and the impact of share buybacks, plus any income you receive on top of that via dividends. So let me explain why dividends are not always good, and I'll start by referencing Buffett. But before we do that, it might be helpful to quickly define what we are actually talking about in this video. What is a dividend-paying stock and what is a dividend-focused investing approach? Well, dividend investing is a type of investing strategy that focuses almost exclusively on stocks that regularly pay out a significant portion of their profits as dividends. So the typical dividend investor will look for companies that have a long track record of consistent dividend payments and ideally consistent dividend increases, and that have the potential to increase their dividends also in the future. The goal of a dividend-focused investing strategy is of course to generate a steady stream of income that can then be used either for consumption or preferably to be reinvested to buy more shares of the same stock or of other stocks. So with that out of the way, let's get back to Warren Buffett. During a past Berkshire Hathaway shareholder meeting, one of the shareholders actually asked Warren Buffett the following question. Warren, what is the ideal business? And let me just share what Buffett said in response to that question. He said, quote unquote, the ideal business is one that earns very high returns on capital and that keeps using lots of capital at those high returns. That becomes a compounding machine. So if you had your choice, if you could put $100 million into a business that earns 20% on that capital, ideally it would be able to earn 20% on 120 million the following year and on 144 million the following year and so on. You could keep redeploying capital at those same returns over time. But there are very, very, very few businesses like that. And this very idea by Buffett was actually also visualized by the investors of long capital, who conclude that dividends and share buybacks should be minimized if capital can be reinvested at high returns. Now I know that dividend advocates will argue that investors can use the dividend that they receive to reinvest the money themselves, either in the stock that paid the dividend or alternative attractively valued stocks. But let me explain the problem that I have with that logic. Investing is all about opportunity cost. If you own a stock that has the ability to generate internal returns of 20 to 25% via internal reinvestments, the vast majority of individual investors cannot match this performance. They are unable to generate returns of 20% if they reinvest the dividend themselves, which by the way also causes lots of transactional costs, which actually add up over time. So of course you want the business to retain its earnings, meaning that profits are kept by the business to be reinvested in the company rather than being distributed to shareholders via dividends. Now on top of that, there is actually another issue that I have with dividends and why I think internal business reinvestments are superior to dividends. Besides the aforementioned opportunity cost, another major drawback of dividends is that in most countries, dividends are taxed, which makes dividends not as tax efficient as share buybacks or internal business reinvestments. In fact, dividends are taxed twice. First, at the corporate level, when companies pay taxes on their earnings, and then secondly, at the personal level, shareholders receiving dividend payments from a company must then pay taxes on the dividend paid out to them as well as part of their personal income taxes. In the UK, for example, a higher rate taxpayer will have to pay taxes of 33.75% on received dividends as of 2022. Put differently, for every $1 you receive from a stock that you own, only around 66 cents can be reinvested. So of course, if you can find a business that can invest that money internally, and maybe more importantly, a business that can reinvest these profits internally at very high rates of return, of course, this form of capital allocation is going to create more shareholder wealth, as for every $1 that is retained in the business, you in fact, get 100 cents of capital and not 66 cents. To highlight that a dividend is not needed to generate superior returns, we just need to look at two of the most successful investments of the last couple of decades. From Buffett's Berkshire Hathaway and Jeff Bezos' Amazon. The underlying stocks of both companies have done phenomenally well and have outperformed commonly used benchmarks by a wide margin. Yet, neither company has ever paid a dividend. Of course, this is a very limited sample size, and I know that I just chose two of the best performing stocks ever. But it showcases that you don't need a CEO who pays a dividend just to please some of the company's shareholders to do well in investing. And in fact, I would argue that a CEO who allocates a significant portion of profits to a dividend could never match the performance of Buffett and Bezos. It's impossible. Terry Smith actually highlighted this with his own analysis. He showed that Buffett had ever chosen to pay out half of Berkshire's earnings as a dividend, which by the way is approximately the average payout ratio of a S&P 500 company. Berkshire's long-term performance would have been significantly worse. Instead of an annual compounded return of 19% that Berkshire generated between 1977 and 2017, the annual return of a dividend-paying Berkshire Hathaway would drop to 14% annually. And this observation can also be confirmed by comparing high dividend yield indices to their regular counterparts. For instance, ever since 2007, the MSCI World High Dividend Yield Index underperformed the regular MSCI index. And similarly, the FTSE All-World High Dividend Yield Index underperformed the regular FTSE All-World Index over both a 5-year and a 10-year period. And these two comparisons even understate the outperformance of the regular indices, as the HDY indices are basically subsets of the regular indices, meaning that the high dividend stocks are still included in the regular stock indices. And this brings us to the third reason why investors should prefer non-dividend paying stocks. One big problem with dividends is that once a management team, a company's management team, has established a dividend, the vast majority of executives are reluctant to ever cut that dividend, as they are worried about how this decision would be perceived by the public. Is it maybe interpreted as a signal of deteriorating profitability or a lack of confidence in future cash flows by the market? It's not particularly uncommon that some businesses even take on debt to be able to sustain their current dividend. So I would argue that a major handicap of a dividend-paying company and of a dividend policy is the lack of flexibility. I can only encourage you to find management teams that make opportunistic capital decisions. Maybe they pay a special dividend when there are no better attractive capital allocation options. Maybe they buy back their own stock aggressively when they believe the stock is trading below its intrinsic value. And ideally, they possess the ability to reinvest the majority of profits back into its own business at high rates of return. But don't get me wrong, I don't ignore dividend-paying stocks altogether. In fact, of the 11 companies that are in my portfolios, 2 companies pay a dividend, and I have no problem with that at all. I don't think you should artificially limit your investable universe by ignoring stocks that pay a dividend. But nonetheless, I think you should look for stocks that have the opportunity to reinvest the vast majority of profits internally and focus on the aforementioned total return that the stock can provide over the long term. And if some of that return comes from a dividend, that's totally fine with me. I just argue that focusing on dividends as the main criterion to consider when picking individual stocks is a bad approach. Now, if you want to learn more about one of Warren Buffett's key learnings and what he learned from another investing superstar, I think you should watch the following video next. Take care.